Hello, Professor Rios. Hope you're doing good. This is Sai Vamshi Kamishetty. I'd like to discuss for the week four discussion question, where we have three topics to choose, and I'd like to pick one topic among us. The topic which I put was the random walk theory implies that events are random, but many events are not random. If it rains today, there is a fair bet that it will rain again tomorrow. So I'd like to choose this topic, and I'd like to go further on this topic. So random walk theory suggests that changes in the stock price have same distribution and are independent to each other. Because of this, I think it can be used to predict how a stock price or a market will move in the future. Random walk theory also suggests that change in stock price have same distribution and are independent of each other. It also says that it's impossible to predict how a stock price or a market will move in the future based on how it has moved in the past. One of the most enduring questions in the financial economics is whether financial asset price changes are forecastable. Mathematically, models of assets prices have unusually rich history that predates the virtual every other aspect of the economic analysis. The intellectual roots of modern financial economics can be tracked back to early attempts to beat the market. Perhaps the easiest characterization of rationally determining the stock price is the random walk hypothesis, which says that the future price changes cannot be predicted from the past price changes. For example, if a stock ABC performed purely last month, it has no bearing on how ABC will perform this month or the next other month, according to the hypothesis. In this respect, the random walk theory hypothesis is not unlike a sequence of coin tosses. The fact that one toss comes up ahead or the sequence of tosses is all heads has nothing to say about what next toss is likely to be. To summarize, past returns cannot be used to predict future returns. It is a study of Kendall. It was discovered that stock prices fluctuate randomly each week. As a sequence, that the random walk hypothesis was born, according to which stock prices fluctuates in a random amounts for each and every week. So when the stock prices were studied, there are no indiscernible trend. Rather than following any pattern, their actions were completely random. An example, I can give you the best example of the idea being used as an effective marketer is that the organization expectations fluctuate or say they deem to be the random. Stocks may no longer follow the random walk at some point, but stock prices will continue to rise since they represent the investor hopes for the future. And this recent research findings have several implications for both individual and institutional investors. The fact that random walk hypotheses can be rejected for the recent US uh, equity returns because it suggests that the stock market is forecastable to some degree. This raises the possibility of superior investments returns through disciplined active investment management. Like profits, in order to get any profits we need to be an active investment manager. There should be an active investment manager, need not to be a market. We should not consider any market inefficiency, but may simply be fair reward for the breakthroughs in the financial technology. For example, few analysts would regard uh, Amgen's hefty profits as a evidence of an inefficient market for the pharmacies. Similarly, even in the markets that are very efficient, that they're very good on returns on new technology in the field of finance. So this is how we generally uh, go with the the given topic, which is on a random walk theory, which implies that that the events are random. So I gave the pretty good example on the stock market, which represents this random walk theory. Uh, and I'd like to conclude with this topic. Uh, Thank you, Professor. Thank you so much. Appreciate for your time. Have a great day.